Welcome to Talk Tickers. Imagine this scenario for a moment. You are staring at a potential acquisition or, I don't know, maybe a massive addition to your fund's portfolio.
Right.
And the growth story is just absolutely blinding. I mean, the charts look like a hockey stick. The management team is projecting a 15% return, and the broader market is just buying the narrative hook, line, and sinker.
Yeah, everyone's on board.
Exactly. You are ready to write a $50 million check. But there is a brutal, unforgiving reality in financial analysis that we really have to confront today in this deep dive.
And it's one people ignore way too often.
Yeah, because that projected 15% return, that beautiful hockey stick graph, it can instantly turn into a painful career-limiting write-down if the underlying revenue recognition is aggressive, manipulated, or just fundamentally flawed.
It is the ultimate trap in fundamental analysis.
Because 6 months after you write that $50 million check, you might realize half of those sales were basically IOUs that will never be paid, right?
Yeah.
And that money just evaporates.
Poof, gone. And as an analyst or a portfolio manager, your evaluation model is completely useless if the top-line numbers are built on an accounting illusion.
Right, because everything flows from that.
Exactly. I mean, it doesn't matter how sophisticated your discount rate is or how deeply you've modeled your terminal growth assumptions. If the revenue isn't real, you are projecting cash flows based on a mirage.
The entire income statement flows from that single foundational number.
It does. It all starts at the top line.
So for you listening, whether you are managing a book of business or maybe you're just grinding through the CFA curriculum right now, assessing the quality of a company's revenue recognition policies means evaluating one core thing.
And it's a critical thing.
Does the reported top-line figure represent a sustainable, cash-backed economic reality? Or is it just a short-term, non-recurring accounting maneuver designed to, hit a quarterly consensus target?
Which happens constantly, by the way.
Right. And that is our mission today. We are covering the foundational rules of revenue recognition, how to measure the cash conversion of that revenue, and the quantitative red flags that signal aggressive accounting.
And just to clarify, we are skipping the basic bookkeeping mechanics today.
Yes, exactly. We are looking at this strictly from the perspective of a practitioner who is tearing apart the financials to find the truth.
Which brings us to the formal definition of earnings quality. Basically, it's the degree to which a company's reported revenue reliably represents its underlying sustainable economic performance.
Sustainable being the key word there.
Right. We spend so much time on this concept and, it's heavily tested in the CFA curriculum because premature or fictitious revenue recognition is the single most common driver of financial misstatement and corporate fraud.
Wow. The most common.
By far. I mean, history is just littered with companies that looked like absolute juggernauts until someone realized the top line was a house of cards.
Because if you can't validate the revenue, then every other metric, gross margin, operating income, earnings per share, it's all fiction.
It's totally made up.
So let's lay down the theoretical foundation before we get into the detective work. The entire economic principle we are dealing with here is accrual accounting.
Right.
And the fundamental goal of accrual accounting is actually pretty noble. It intentionally separates the recognition of revenue from the actual collection of cash to better match economic activity with the period in which it actually occurred.
The matching principle.
Exactly. So if you sell a tractor today, but the farmer pays you in 90 days, well, accrual accounting says you earn the money today.
Which makes sense economically.
It does. But that separation between the economic event and the cash changing hands, that creates a gap. And that gap is exactly where the manipulation lives.
Oh, absolutely. That gap is the breeding ground for aggressive assumptions. And to govern that space, the accounting world uses a converged global standard.
Right, the new rules.
Yeah. Under U.S. GAAP, it's known as ASC 606. And internationally, it is IFRS 15. The standard is structured as a 5-step framework. And the key here is that you can't just memorize the 5 steps like a grocery list.
You have to understand the economic intuition behind every single one.
Exactly. So step 1 is identifying the contract with the customer. Now, that might sound incredibly basic. You might think, well, do we have a signed piece of paper?
Sure, yeah.
But the standard requires that the contract be enforceable and, crucially, that it possesses commercial substance.
Hold on. Let's break down commercial substance because, that sounds like a phrase lawyers use to bill more hours.
It does sound like legalese.
What does that actually mean in a spreadsheet? Does it mean the risk, timing or amount of the entity's future cash flows is expected to change because of this contract.
That is the exact technical definition, yes.
Because if two telecom companies are just, swapping identical lengths of fiber optic cable network capacity in different cities just to inflate their gross trading volumes, there is no real economic change there.
Right. That is the classic example. We saw exactly that kind of capacity swapping in the early 2000s telecom boom.
Oh, right. Enron era stuff?
Exactly. Companies would trade network access with each other, book massive amounts of revenue, and essentially pass absolutely no cash back and forth.
Just a wash.
A total wash. So the new standard explicitly shuts that down. If the risk, timing, or amount of your future cash flows doesn't change, like if you are just trading identical assets to pump up the top line, there is no commercial substance.
You stop right there.
You stop at step one, no revenue is recognized.
Okay, so assuming we actually pass step one and real economic value is changing hands, we move to step two, which is identifying the performance obligations.
Right.
The core question here is, what distinct goods or services were promised to the customer?
Yeah.
It's about unbundling the deal, right?
Unbundling is the perfect word for it.
So if I buy an enterprise software package and the vendor sells me the software license plus a year of mandatory, highly specialized technical support, those are likely two distinct performance obligations hiding inside a single contract.
Yep. You have to separate them to reflect the true economics of what is being delivered.
And separating them is vital because you deliver the software today, but you deliver the support over the next 12 months.
Exactly. If you don't unbundle them, you might recognize all the money today, which totally violates the core matching principle we talked about.
Right.
So moving to step three, we have to determine the transaction price. Again, this sounds deceptively simple. You just look at the invoice, right?
I think so.
But the transaction price is notoriously complex because you have to account for variable consideration. We are talking about things like volume discounts, rebates, performance bonuses, or even the customer's right to return the product.
Okay, let's use an original analogy here to make variable considerations stick for you listening. Think about a superstar baseball player signing a new contract.
Okay, I like this.
The contract guarantees him $20 million a year, but it includes a $5 million bonus if he wins the MVP award. The team doesn't just book his salary as $25 million on day one.
Right, they can't.
They have to estimate the likelihood of him winning MVP. So is variable consideration treated the same way? Like the company has to guess how many products will be returned or how many volume rebates will be triggered?
Yes, and the standard dictates exactly how you make that guess. You have to estimate that variable consideration using either the expected value method, which is basically a probability-weighted average of all possible outcomes, or the most likely amount method.
When would you use the most likely amount method?
You'd use that if there are really only two possible outcomes, like hitting a specific performance bonus or missing it entirely.
Got it.
But here is the critical mechanism that keeps management from going wild with these guesses. It's called the constraint.
Ah, the constraint. This is where the auditors step in and say, prove it.
That is the functional role of the constraint. Exactly. You can only include variable consideration in your transaction price to the extent that it is highly probable that a significant reversal of cumulative revenue will not occur in the future.
Highly probable.
Right. So if a construction company gets a bonus for finishing a building early, but they are only, say, 1 month into a 3-year project, the uncertainty is just too high.
There's too much that could go wrong.
Exactly. It is not highly probable yet, so they must constrain that bonus out of the transaction price until the uncertainty is resolved.
That makes a lot of sense.
Furthermore, step 3 requires adjusting for significant financing components.
Wait, let me stop you there. Significant financing components. Are we talking about the time value of money creeping into top-line revenue?
We are.
So if a customer pays a home builder $1 million today in cash, but the builder isn't going to deliver that custom home for another 2 years, the builder effectively just got a 2-year interest-free loan from the customer.
The standard recognizes that exact economic reality. That transaction price includes an implicit interest expense.
Oh, wow.
Yeah, so the builder has to strip out the financing component so that the revenue recognized reflects what the customer would have paid in cash at the exact moment the house was delivered.
That's fascinating.
You also have to measure any non-cash consideration, like, if a client pays you in shares of their own stock instead of cash, you have to measure that at fair value at contract inception.
Okay, so through step 3, we have calculated the total constraint-adjusted transaction price.
Correct.
Step 4 is allocating that total price back to the distinct performance obligations we identified back in Step 2. We do this using what is called the standalone selling price, or SSP.
Right, the SSP.
So let's do some math. If a tech company sells a bundled package for $100,000, but they normally sell the software license alone for $80,000 and the annual support service alone for $40,000, the sum of the standalone prices is $120,000.
But the customer only paid $100.
Right. So we have to use those relative standalone prices to proportionally divvy up the actual $100,000 transaction price.
Building on that math, the license represents 2/3 of the standalone value, right?
Yeah.
80 over 120. And the support represents 1/3. Therefore, you allocate roughly $66,000 of the transaction price to the license and $33,000 to the support.
So you're just prorating it.
Exactly. And this allocation is vital because it dictates the timing of the revenue, which takes us to Step 5. Recognizing the revenue when or as the entity satisfies a performance obligation.
The final step.
This is the culmination of the entire framework. We have to differentiate between recognizing revenue at a point in time versus over time.
Well, point in time makes intuitive sense, right?
Yeah.
You go to a dealership, you buy a car, they hand you the keys, control is transferred.
Right, immediate transfer.
Revenue is recognized right then and there.
Okay.
But over time, rate recognition is where the estimates really start to pile up. If a company is building a massive cruise ship over 4 years, they don't wait until year 4 to recognize the revenue. They recognize it as they build it.
Because the customer simultaneously receives and consumes the benefits as the entity performs. Or the entity's performance creates an asset with no alternative use, and the entity has an enforceable right to payment for performance completed to date.
That's a mouthful, but it makes sense for a custom cruise ship.
Right. And to measure that progress over time, companies use either input methods or output methods.
What's the difference there?
An input method would be recognizing revenue based on the costs incurred to date relative to the total expected costs of the project. This is your classic percentage of completion accounting.
Good. And output.
An output method would be recognizing revenue based on direct measurements of the value transferred to the customer, like specific milestones reached or units produced.
Okay, I need to push back on this entire framework for a second.
Okay.
We hear this phrase, principles-based model, thrown around as the gold standard of modern accounting. ASC 606 was designed to reflect the true underlying economics of transferring control, rather than just ticking boxes. But honestly, as an analyst, doesn't moving away from strict industry-specific bright-line rules just give management a massive subjective gray area to exploit?
I see where you're going with this.
I mean, think about what you just outlined. Management gets to estimate unobservable standalone selling prices. They get to forecast variable consideration. They get to decide what constitutes a highly probable reversal. They get to choose between input and output methods.
It's a lot of choices.
That is an enormous amount of discretion handed to the exact people whose bonuses are tied to the resulting numbers.
The tension you are highlighting is the central debate in modern financial reporting. You are not wrong. The discretion is immense.
It feels risky.
But consider the alternative we left behind. Under the legacy rules-based system, you had hundreds of highly prescriptive, industry-specific rules. Management teams would intentionally structure economically hollow transactions just to squeeze through a technical accounting loophole. They engineered the contracts to meet the rule, totally ignoring the reality.
So they were playing the system anyway.
Exactly. The principles-based shift was intended to stop that engineering, but you are absolutely correct that it fundamentally shifted the analyst's job.
Meaning we have to stop trusting the math and start attacking the assumptions.
Yes. We are no longer just checking compliance against a rigid checklist. We are actively assessing management's structural assumptions.
Give me an example of attacking an assumption.
If management assumes a 0% return rate on a brand new, untested consumer product just to avoid constraining the transaction price and pull more revenue into the current quarter, well, that is an assumption you have to isolate and adjust in your model.
Which brings us into the practical application part of our deep dive. How do practitioners actually bridge this gap between audited GAAP numbers and sustainable economic reality?
We use a quality of earnings, or QOE, analysis.
Think about it this way for you listening. An audit is just checking if a car passes state inspection. Are the blinkers working? Are the emissions within legal limits? Do they follow the rules?
Right.
A QOE report is a team of mechanics tearing down the engine block to see how long it will actually run before it blows up.
The mechanical teardown is the perfect way to visualize it. In practice, a QOE analysis can be approached from two directions.
Okay.
There is the top-down approach, where you start with the company's reported normalized EBITDA and work backwards. You review the specific add-backs and adjustments management is proposing to see if they are legitimate, one-time items, or if management is trying to pass off recurring operating expenses as extraordinary events.
Right, the classic, oh, this restructuring cost is totally a one-time thing, even though we do it every year.
Exactly. But the gold standard, the real forensic work, is the bottom-up analysis.
The bottom-up analysis is where you really get your hands dirty in the general ledger, right? You aren't just looking at the final polished income statement. You're looking at individual journal entries.
You start at the transaction level and build up to a normalized cash flow figure. This ensures absolute data integrity and strips away whatever narrative management is trying to spin in their MD&A section.
You're looking for cash-backed recurring earnings.
Yep. You are reconciling the subledgers to the bank statements. It is incredibly tedious, but it is the only way to uncover the specific aggressive tactics management uses to stretch that five-step model we just talked about.
Well, let's get into those tactics. I want to talk about how management actively manipulates these rules, starting with an absolute classic, the bill and hold arrangement.
Oh, the bill and hold.
This is where a company recognizes revenue before a customer actually takes physical possession of the goods.
And it is notorious at quarter end. Imagine a manufacturer of commercial grills. It's December 28th. The sales team is $10 million short of their annual quota.
Panic time.
Exactly. So they call up their biggest distributor and offer a massive discount if they buy the inventory today. But the distributor says, well, we don't have warehouse space right now.
So no deal.
Not quite. Management says, no problem, we will bill you today, and we will just hold the grills in our own warehouse until you need them. They segregate the inventory, book the sale, and hit their quota.
But the economic reality hasn't actually changed. The physical grills are sitting in the exact same spot on the factory floor they were yesterday. The manufacturer still bears the risk of loss if the warehouse burns down.
Which is why bill and hold arrangements have incredibly strict criteria under Step 5 for control to actually transfer, but management aggressively pushes the boundary.
Let's look at the quantitative impact of this because it's staggering. Suppose a target company reports $150 million in revenue.
Okay.
You perform a bottom-up QOE review and discover that $12 million of that revenue was tied to bill and hold arrangements where the customer hadn't actually requested the arrangement or the goods weren't genuinely ready for physical transfer.
So that $12 million must be reversed.
Right. So out of $150 million, reversing $12 million is an 8% overstatement of top-line revenue. That sounds bad, but maybe not fatal, but we have to factor in operating leverage.
Operating leverage turns an 8% top-line problem into a catastrophe further down the income statement.
Walk us through that math.
Let's say this company has high fixed costs and reports $25 million in EBITDA. The gross margin on that $12 million of fake revenue flows almost entirely to the bottom line.
Because the fixed costs are already covered.
Exactly. So reversing that $12 million in revenue might wipe out $5 million of EBITDA. Suddenly, your 8% top-line inflation represents a 20% overstatement of EBITDA.
Wow.
Yeah. If you were valuing this company at a 10x EBITDA multiple, the purchase price just dropped by $50 million because of a warehouse trick.
That is terrifying. Just completely terrifying. Another massive tactic, especially dominant in the tech sector, is upfront versus ratable recognition.
This one is everywhere right now.
Right. A software company might sell a standard 12-month subscription to their platform. But to make their current quarter growth rate look explosive to venture capitalists, they try to classify massive routine onboarding or setup fees as a completely separate, distinct performance obligation.
Going back to Step 2.
Exactly. They claim they satisfied the setup obligation on day one, so they recognize 100% of that setup fee up front, while recognizing the software license ratably over the next 12 months.
And the fundamental question the analyst must ask is, does that setup service have standalone value to the customer without the software?
Usually the answer is no.
Right. If the setup is just configuring the specific software to run on the client servers, it has no independent value. It is not a distinct performance obligation.
So they shouldn't unbundle it.
By unbundling it and recognizing it up front, management is basically just stealing future revenue and pulling it into the current period. It creates a temporary spike in growth that will inevitably lead to a revenue shortfall in subsequent quarters.
Let's pivot to something even more insidious. Estimate manipulation. This doesn't even require a customer to agree to a weird contract. This is entirely within management's control inside the accounting system.
The dark arts.
Exactly. I'm talking specifically about the allowance for doubtful accounts, the ADA. Break down the mechanics of how a CFO can use this reserve to manufacture profit out of thin air.
The mechanics are beautifully simple and highly dangerous. When a company makes sales on credit, they know from historical experience that a certain percentage of customers will simply never pay. They will go bankrupt or default.
Accrual accounting requires the company to estimate those future bad debts and record an expense immediately in the same period the revenue was recognized to adhere to the matching principle.
Right. They debit bad debt expense, which lowers net income, and they credit the allowance for doubtful accounts, which is a contra asset that lowers the total accounts receivable balance on the balance sheet.
So the ADA is essentially a rainy day fund that reduces your reported assets to reflect the reality that some people are deadbeats.
Functionally, yes. Now, imagine a company's historical write-off rate has averaged 3.5% of gross receivables for the last 5 years. They have a $50 million accounts receivable balance.
So they should have roughly a $1.75 million ADA reserve.
Correct. But it's December 31st.
Yeah.
The CFO realizes operating profit is coming in $800,000 below the threshold required to trigger executive bonuses.
Uh-oh.
Miraculously, the CFO decides that macroeconomic conditions have improved, customer credit profiles are stronger, and they drop the estimated ADA rate from 3.5% down to 1.8%.
Without a single underlying fact changing in the real world.
None.
So they reduce the required reserve to $900,000. What happens to that $850,000 difference?
They reverse it out of the reserve. They debit the ADA on the balance sheet, and they credit bad debt expense on the income statement.
Which means?
That $850,000 flows straight through to pre-tax income.
Wow. There is no cash associated with that. Not a single customer wrote them a check.
Not one. It is purely an accounting lever pulled in a dark room to artificially inflate current period earnings and trigger a bonus payment.
So, as an analyst staring at this, how do we catch it? Management isn't going to highlight this in a press release. We have to rely on quantitative red flags. And the absolute most powerful early warning system for everything we've talked about, bill and hold, upfront recognition, bad debt manipulation, is DSO.
Case sales. Outstanding.
Walk us through the formula and why it's the holy grail of revenue analysis.
DSO measures how many days, on average, it takes a company to collect cash after a sale is made. The formula is your ending accounts receivable balance divided by your total revenue for the period, multiplied by the number of days in that period.
It tells you the speed of cash conversion.
Exactly.
Let's walk through a real-world scenario to show why this matters so much. You are analyzing a publicly traded manufacturer. Their quarterly earnings report hits the wire, and revenue has grown 12% year over year.
Sounds great.
The headline looks fantastic. The stock is up in pre-market trading. But you dig into the balance sheet, run the DSO calculation, and you see that while revenue grew 12%, their accounts receivable balance just jumped 45%. Why is that a blaring siren?
Because the mathematical relationship between revenue and receivables has completely broken down. If receivables are growing nearly 4 times faster than revenue, the cash collection cycle is failing. You are booking sales, but nobody is sending you cash.
And when you see that massive divergence, it usually signals one of two things.
The first is channel stuffing. Management is pushing excess inventory to distributors at quarter end, perhaps offering massive undisclosed return rights or extended payment terms.
So the distributor accepts the inventory because they don't have to pay for it anytime soon, allowing the manufacturer to book the revenue.
Right. But the end consumer hasn't actually bought the product. The manufacturer just moved the inventory from their balance sheet to the distributor's balance sheet and called it a sale.
And when those products don't sell, they will all be returned in the next quarter, causing a massive revenue reversal.
Exactly. The second signal a spiking DSO provides is deteriorating customer credit quality. To keep that 12% revenue growth narrative alive, the sales team is scraping the bottom of the barrel.
They're signing contracts with customers who have terrible credit profiles and offering them loose payment terms just to get a signature on the contract.
Either way, whether it's channel stuffing or credit deterioration, that 12% revenue growth is not converting to cash. It is an illusion.
This highlights exactly why comparing the income statement to the balance sheet is non-negotiable. Another vital quantitative check we use is margin benchmarking.
Yes, benchmarking is huge.
Let's say you are analyzing a target company in the industrial services sector. The industry average gross margin is dead flat at 45% across all major competitors. But this target company is consistently reporting a 52% gross margin.
A huge premium.
My first instinct might be to think, wow, they have a superior business model, better pricing power, or incredible operational efficiency. Why do I need to suppress that instinct and look for aggressive accounting first?
Because in mature, highly competitive industries, a 700 basis point advantage in gross margin is extremely rare to achieve purely through operational brilliance. You have to investigate if the target company is improperly capitalizing costs that their peers are immediately expensing.
Break down the difference between capitalizing and expensing in this context. How does that manipulate the margin?
Well, when you expense a cost, say routine equipment maintenance or aggressive marketing spend, it hits the income statement immediately, reducing your profit for that period.
Right.
When you capitalize a cost, you are claiming that the expense creates a long-term economic benefit. So you record it as an asset on the balance sheet and slowly amortize it over several years.
So it spreads the hit out.
Exactly. If a company takes operating expenses that should reduce current period margins and instead moves them off the income statement and onto the balance sheet as assets, they artificially inflate their current gross margin and operating profit.
They look insanely profitable compared to peers, but it is purely because they are hiding costs on the balance sheet.
So they are deferring the pain. They are inflating today's margins by guaranteeing lower margins in the future when that capitalized asset finally has to be amortized. It's almost like an accounting Ponzi scheme.
And it is worth noting here that these revenue risks change entirely based on the specific business model. We've talked exclusively about corporate for-profit entities, but the principles of revenue recognition apply everywhere, and the manipulation takes different forms.
Oh, absolutely. If you are analyzing a not-for-profit organization, you aren't usually worried about bill and hold arrangements.
Right.
The primary risk involves the misclassification of grants, specifically classifying conditional, non-exchange grants as earned, unconditional revenue.
Give me an example of that.
Sure, a donor might pledge $1 million, but the condition is that the NFP must first raise a matching $1 million from other sources. If the NFP books that initial $1 million as revenue before the condition is met, they are overstating their financial health.
Or consider employee benefit plans, like a 401k or a multi-employer pension fund. The risk there is completely different. The manipulation often involves treating pure pass-through funds like individual participant contributions or tuition reimbursements that just pass through the plan's accounts as top-line operational inflows.
Which is incredibly misleading.
It inflates the apparent scale and cash-generating ability of the plan. You cannot apply a one-size-fits-all checklist. You have to fundamentally understand the specific economic engine of the entity you are analyzing.
And regardless of what type of entity you are looking at, practitioners have to heavily scrutinize the internal control environment. The financial statements are only as reliable as the underlying IT systems and human controls producing them.
Right.
In the audit opinions, we carefully distinguish between a significant deficiency, an SD, and a material weakness, an MW.
Let's draw the line there. A significant deficiency sounds bad, but a material weakness sounds fatal. What is the practical difference for an analyst?
A significant deficiency is a flaw in internal controls that is important enough to merit the attention of the audit committee, but it isn't expected to cause a massive error. Maybe a mid-level manager is signing off on journal entries that should require a director's signature.
Okay, so a process flaw.
Yeah. A material weakness, however, is a much higher threshold. It means there is a reasonable possibility that a material misstatement of the financial statements will not be prevented or detected on a timely basis.
So if I am reading a 10K, and I see a material weakness disclosed in the internal controls over financial reporting, you are telling me the numbers I am plugging into my valuation model are essentially a rough draft. They are guesses.
You must heavily discount the reliability of those numbers. Furthermore, you have to look at the behavior of the auditors themselves. Frequent auditor turnover is a massive glowing red flag.
Because they're firing the auditors who disagree with them.
Exactly. Audit firms do not willingly walk away from lucrative recurring annuity revenue streams unless the underlying legal or reputational risk of signing off on the client's books is simply too high. If a company changes auditors twice in 3 years, you have to assume management is shopping around for an auditor who will agree with their aggressive revenue recognition policies.
We also need to check the fee structure. between the company and the auditor. I always look at the proxy statement to see the breakdown of audit fees versus non-audit fees.
That's a great check.
If a company is paying their auditor non-audit fees, things like strategic consulting, IT system implementation, or aggressive tax advisory, that exceed 150% of the base audit fee, the auditor's independence is severely compromised.
The conflict of interest becomes overwhelming at that point. It often indicates deep, ongoing disputes over revenue policies, where management is essentially paying exorbitant fees for consulting as a backdoor way to justify their aggressive recognition models and keep the audit partner happy.
Right. If the audit firm makes $2 million checking the books, but $8 million consulting on how to structure contracts, they have a massive financial incentive to look the other way on borderline revenue recognition.
It's just human nature.
Let's pivot to how all of this integrates into the CFA curriculum, because the depth of knowledge required scales dramatically as candidates progress across the 3 levels. It's not just about knowing the definition, it's about application.
Very true.
For level I candidates, the focus is highly mechanical. You must know the strict definitional mechanics of the 5-step ASC 606 model backward and forward. You need to know how to calculate DSO flawlessly given a random set of balance sheet figures.
The Level I exam tests your ability to process the rules, and a major stumbling block at Level I is handling contract modifications. You have to know the exact criteria for when a mid-contract change requires a prospective adjustment versus a cumulative catch-up adjustment.
Let's make that concrete with a scenario. Imagine a construction company is building a $10 million bridge for a city. Halfway through the project, the city asks to add a $2 million off-ramp to the contract. How do we treat that?
Well, it depends on whether that off-ramp is a distinct good. If the off-ramp is distinct and priced at its standalone selling price, it is treated as a separate new contract. You use a prospective adjustment.
Meaning you leave the past revenue alone.
Exactly. You don't touch the earnings already reported, and you just recognize the new $2 million as the off-ramp is built.
But what if the modification isn't distinct? What if the city just asks them to change the structural grade of the steel being used on the bridge itself?
In that case, the remaining goods are not distinct from what has already been transferred. It is all part of a single integrated performance obligation.
So that changes things.
Completely. That triggers a cumulative catch-up adjustment. You have to immediately recalculate the entire transaction price and the percentage of completion, and you book an adjustment to revenue in the current period to catch up to where you should be under the new terms.
And level I candidates must be able to calculate both outcomes.
You have to know the math for both.
Moving to level 2, the curriculum entirely shifts from basic mechanics to critical evaluation. Candidates are no longer just tested on calculating the rule. They are tested on evaluating the actual quality of the financial reports. You are expected to spot the warning signs of manipulation we just spent the last hour discussing. You have to evaluate the quality of a company's accruals.
Level 2 requires you to act as the detective. You need to be able to dive deep into the footnotes of the financial statements to distinguish between conservative and aggressive accounting choices.
Give me an example of a footnote red flag.
Well, if you see a footnote detailing a change in how a company estimates the standalone selling price of their bundled software, Level 2 expects you to recognize that as a potential red flag for pulling revenue forward.
By level 3, this concept elevates again. It links directly to equity valuation and portfolio risk management.
Yeah.
You aren't just identifying the aggressive accounting, you are mathematically correcting for it.
Exactly.
Analysts must normalize historical earnings. You have to strip out these accounting illusions, reverse the bill and hold anomalies, and adjust the manipulated ADA reserves so that you can forecast a truly sustainable free cash flow.
Furthermore, at level 3, you have to assess the corporate governance risks associated with everything we've discussed. If the board of directors is allowing the CFO to manipulate the bad debt reserve to hit executive bonus targets, or if the audit committee is asleep at the wheel while internal controls deteriorate into material weaknesses, that is a severe governance failure.
Yeah, that's not just a math problem, that's a leadership problem.
Exactly. As a portfolio manager, you must apply a governance discount to the stock's valuation. You cannot pay a premium multiple for a company with broken oversight.
And here's the trap that catches so many candidates, and frankly, so many junior analysts in the real world. You can memorize the 5 steps of ASC 606 perfectly. You can recite them in your sleep. But you will fail the exam questions and you will lose money in the market when you are presented with a real-world scenario and asked to calculate exactly how a specific change in estimating variable consideration mechanically impacts the balance sheet and future cash flows.
Knowing the rule is only step one.
Right. Calculating the economic impact of the rule being stretched by a desperate management team is the actual job.
That is the crucial distinction between a bookkeeper and a financial analyst. The bookkeeper records the transaction. The analyst questions the economic reality of the transaction.
Which brings us to the one question. The single most important concept you must internalize when encountering revenue analysis in practice. You must always ask, is the company's revenue growth directly matched by its cash collection, or is it merely inflating accounts receivable?
Because revenue without cash is just an accounting illusion waiting to be written off. It is a mathematical phantom.
Let's recap the critical takeaways from this deep dive. First, while the five-step model of ASC 606 and IFRS 15 dictates the rules of engagement for revenue recognition, it is a rigorous, bottom-up quality of earnings analysis that actually reveals the economic substance beneath those rules.
You have to unbundle the contracts and challenge the estimates.
Second, quantitative metrics like DSO, margin benchmarking, and qualitative shifts in things like bad debt estimates or internal controls are your absolute earliest warning systems for aggressive recognition. If the narrative the CEO is pitching on the earnings call completely decouples from the cash flow metrics, you trust the metrics every single time.
Always trust the cash. And as a brief reminder, this content is intended for educational purposes only and should not be construed as investment or accounting advice.
Before we wrap up, I want to leave you with a final provocative thought to mull over. We have spent this entire session talking about how difficult it is for a human analyst to manually dig through general ledgers, reconcile DSO trends, and hunt for subtle shifts in accounting estimates hidden in the footnotes.
It's exhausting work.
But consider how the rapid integration of artificial intelligence and natural language processing in financial analysis might completely revolutionize this field. Imagine an AI agent trained to instantly detect boilerplate disclosures, cross-reference them against peer companies in milliseconds, and subtly track multi-year microscopic shifts in accounting policies buried deep within a 300-page 10K.
Shifts that a human analyst exhausted at 2 REM might completely gloss over.
Exactly. The technological tools we use to extract the data are changing at blinding speed, but the underlying necessity of verifying economic truth remains exactly the same. An AI might flag the anomaly, but the analysts still have to understand the mechanism of the manipulation.
The machine finds the breadcrumbs, but you still have to know where they lead.
Apply these frameworks to your current portfolio holdings tomorrow morning. Run the historical DSO trend on your largest positions. Dig into the footnotes for changes in how they estimate variable consideration. Thank you for engaging with the Talk Dickers curriculum today. Keep tearing down the engine.